Hello and welcome back to the Fixed Income Securities series of NISM. Let's continue with the next chapter, that is chapter 2.1.3 Corporate Bonds. A corporate bond is issued by a corporate to raise capital. The performance of the bond during its life depends on future revenues and profitability of the corporate. Debt is typically cheaper source of financing for corporates, and unlike issuance of more equity, their ownership structure is not diluted. In some cases, the corporate's physical assets may be used as collateral. Corporate bonds carry higher risk vis-a-vis government bonds, and hence the bondholders accept higher interest rates to compensate for the additional risk they take while investing in the bond. Corporate issue short-term papers like commercial papers (CPs) to fund their short-term requirement or for their working capital funding. The corporate papers are issued either through public issuance or private placements. The creditworthiness of the issuer, that is, issuer's ability to discharge its financial obligations, is to be assessed periodically by one or more of credit rating agencies. The bond's credit rating and ultimately the company's credit rating impacts the market price of the bond in both primary and secondary markets. The credit rating agencies (CRAs) assign ratings through later grades for their common and global understanding. The highest quality and safest bonds are given AAA, while the high-risk bonds are known as junk or high-yield bonds. The difference between the yields on corporate bonds and government bonds is called the credit spread. Chapter 2.1.4 Securitized Debt. Securitization is the process of monetizing a liquid loan asset of a lender, such as a bank, into a liquid pool. Tradable assets. Securitization is achieved by creation of a special purpose vehicle (SPV) and structuring the pool of loans into tradable bonds. Securitized or asset-backed securities transfer ownership of assets, that is, loans and receivables, to the SPV. Chapter 2.2 Classification of fixed income securities based on maturity. Bonds are issued for various maturities depending on the requirement of funds as well as the demand from the investors. Long-term bonds are generally costlier than short-term loans as the funds are locked in for a longer period of time. While investors may suffer from illiquidity, bonds may be classified in terms of maturities like ultra short-term, medium-term, and long-term. Short-term borrowings are typically made for working capital requirement, whereas long-term funds are used for project capital and infrastructure funding. Collective investment schemes are also create debt-oriented funds using such maturities. The returns on bonds by similar rating class of issuers also vary according to the maturity, which forms the basis of yield curve theories. Chapter 2.2.1 Overnight debt borrowings. Typically, banks borrows overnight funds from the money market as well as from the RBI. These borrowings can be collateralized or clean. Collateralized borrowings cost less vis-a-vis clean borrowings. The RBI plays a very important role in this market through absorption or supplying liquidity through banks and primary dealers. Chapter 2.2 Ultra short-term debt, that is money market. Short-term borrowings up to 1 year are covered under this category, mostly money market instruments like commercial papers, CP, certificate of deposits, CD, treasury bills, TB, cash management bills, CMB, etc. belong to this category. Chapter 2.2.3 Short-term debt. Bonds with maturity spanning from 1 to 5 years are referred to short-term bonds. Bonds maturing within a year are classified under money market instruments are discussed above. Chapter 2.2.4 Medium-term market. Medium-term debt. These are bonds maturing in 5 to 12 years. These are also referred to as intermediate bonds. Generally, the bulk of debt issuances take place in this segment. Chapter 2.2.5 Long-term debt. These are bonds with maturity beyond 12 years. Mostly Government of India bonds are of long-term maturity. Chapter 2.3 Classification of fixed income securities based on coupon. The promised interest as per the indenture of the bond is referred to as the coupon. The coupon payments on bonds have a predetermined payment frequency and may be paid annually, semi-annually, quarterly, or monthly. Bonds are classified on basis of coupons as these are returns on the investments made by the holders. Chapter 2.3.1 Plain vanilla bonds. A vanilla bond is the simplest form of a bond with a fixed coupon and defined maturity and is usually issued and redeemed at the face value. It is also known as a straight bond or a bullet bond. These bonds have intermittent cash flows in the form of coupons received as well as the final cash flow of the face value of the bond on maturity. So that's it for now. We will discuss the next chapter in